This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. This is an important week because tech is on sale, supposedly. We've had a couple-day pullback in the NASDAQ, and suddenly everybody's like all doom and gloom about the AI stocks. AI is over. It's got overextended. It's not going to be what everybody said it's going to be. And now those stocks are selling off. But are there really any deals there? I thought we'd take a look because I have been telling people, especially value investors, to buy on pullbacks some of the AI infrastructure stocks. And so now maybe here we are, maybe getting this pullback. Should you be buying? Are these deals? Should we just be putting them on our watch list and see if they get a little bit cheaper here? I do get greedy on these types of pullbacks, right? Because we've had several big pullbacks in the AI stocks. Since all this began in 2023, you've had numerous opportunities to dive in when everybody was gloomy and thinking it was over. Remember back in the day in 2023 when people were actually saying that NVIDIA's revenue was fake? Remember that? So here we are a couple of years later. It wasn't fake. And some people still are not in this trade. I still like it going forward, despite all this recent doom and gloom about how it's a bubble or it's overextended. I don't believe that it is either a bubble or overextended. However, there is some bubblicious behavior, we should call it, in a couple of the names in the AI area. So as value investors, we should be avoiding those, and we should be looking for the ones that could be deals on a bigger pullback in the shares here. So what exactly am I talking about? So let's lead off with the one that has seen the biggest pullback, the AI stock. And this is one that isn't in infrastructure, and it has been in no way on the value radar for the last 2 years. It is one of the best performing stocks. And it is obviously, or maybe not obviously, but it is Palantir. PLTR. Just saw some recent discussion about how valuations were quote unquote absurd. That's a term I have used for quite some time. But as a value investor, I have choices and I choose not to buy it. The growth investors can buy it, but now we are starting to see a bit of a pullback in it. This would be normal given how incredibly hot it's been even just year to date. So Palantir is down 16.5% in the last 5 sessions when I'm recording this on August 20th. But it is getting a bounce today. And by the time you listen to this, maybe it's wiped out some of these losses. It did fall as much as 22% over the last 5 sessions. So that's a nice little pullback. That's a bull or a bear market pullback, right? Just like a bear pullback. And I feel like some computer programs probably had a 20% decline as a time to buy. And so that is why we're starting to see some buying, and it's now not down 20% or more. It's down 16.5. But why are the valuations of Palantir absurd, even with this pullback? Because it is one of the most expensive stocks that actually has good fundamentals that I have seen in many years, maybe even decades, really. Some of this was going on in the dot-com boom. You had the dot-coms that made no money that, soared, and everybody thought that was absurd. But then you had the legit companies, the big tech titans, as we call them, Cisco, Intel, Microsoft, Dell, to name just 4, that also surged in the late 1990s, but actually had the actual fundamentals there to somewhat justify it until they didn't. And if you were around back then, you may recall that some of the valuations just got a little too high, and then the stocks did sell off in 2000 to 2002. But what was too high it obviously had stretched PEs, but everybody said, oh, we don't look at PEs for these tech stocks. We look at price to sales ratios. And as we know, as value investors, a price to sales ratio at 1 or less means it has value. That is incredibly low. That means, at like 0.5, we're paying 50 cents for every dollar of sales. But what is an overextended price to sales ratio? Well, back then, and even right now, it usually means 10 or higher, because that means I'm paying $10 for every $1 of sales. So you can see why that might not make much sense on a fast growing stock or company. You do pay a premium for those sales. Everybody wants them, so you got to pay up to get them. But at some point, it even is like, just as the one analyst said, absurd to be paying that kind of premium. And Palantir isn't even in the 10 times category or even the 50 times category. Right now, even with the recent pullback, price to sales ratio is at 108. And I've said on Twitter, I've tweeted out on X that I've never seen a stock with very good fundamentals actually trading at this level with the price to sales of 108. It has a price to book of 62. The PEG even is at 6. PE, forward PE, which everyone said we don't care, but if you do care, is at 244. So all of these are quote unquote absurd levels, and it was destined to pull back. And maybe this is all we're going to get for now. But eventually valuations do matter, as we know here on the Value Investor Podcast. As Warren Buffett has said many times, Benjamin Graham as well, valuations do matter. But when you're in the heart of the growth story and thinking this is going to go on for forever and I have to own this company, that's where the growth investors are willing to pay up. But at some point, even they aren't willing to pay up. So right now it's getting this bit of a pullback. And just for fun, because everybody was complaining about NVIDIA and its valuation 2 years ago when everything broke out on the AI side, they also have excellent fundamentals right now. We're about to get their earnings report, but we know it's good. They've been growing revenue and earnings at a steady clip over the last 2 years. They basically doubled their revenue, which is also insane for a company of this size. But their price to sales ratio, which is stretched, but it's at 28 versus 108 for Palantir. People have been willing to pay up the 28 for the last 2 years. It's been around that level for a while now. PE is at 41. That makes it look positively cheap compared to Palantir. And the PEG ratio for NVIDIA, which is one of the reasons I've advocated that investors should be buying NVIDIA, the PEG ratio is at 1.46. So a PEG of 1 and under means a stock has both value and growth. And this is very low, 146 on the PEG ratio. And that is because the stock, while it's gone up, is not going up quite as rapidly a rate as it was in the past 2 years. And the earnings, though, are still rising dramatically. So on NVIDIA, earnings expected to be up 42.8% this fiscal year and another 32.6% next fiscal year. So that's why we're getting the PEG, even with the stock hitting some new highs recently, but not quite as crazy as what is happening with Palantir in terms of the stock appreciation. So Palantir on the valuation and fundamental side, like I said, it too has very excellent fundamentals. This year, earnings up 58.4%. Next year, 30.5%. So why is its PEG so high? Well, because the stock has just really outpaced what this earnings growth is even looking like. So it's been one of the best performing stocks year to date. Palantir is up still, even with the recent pullback, 105%. Just year to date, we're in August of 2025. So the earnings growth can't keep up, but eventually it will. That's why you have some people shorting it. You have Andrew Left at Citron. He's the one who said it was absurd, the valuations, and he's shorting it. But as a value investor, I'm staying wide with Palantir. But this whole podcast is designed to look for some buying opportunities in the AI stocks. NVIDIA, if that was to pull back again, because it has pulled back numerous times since 2023, if that was to see a bigger pullback, possibly after its earnings report or something, it would be even more attractive than what it is here. So I still do like NVIDIA and have it on my watch list for entry at a better entry level. But there are some other stocks in this area in the infrastructure side. We've talked about them on prior podcasts when I said, is there any value in the AI stocks? What are the cheapest AI stocks? I've covered these in the last 2 years, but it's been a while because some of them aren't so cheap anymore. So I didn't think, we should cover it, but now we are getting some bit of a pullback on the Palantir pullback, on this idea that AI is quote unquote over. We've heard this numerous times, but this is healthy. I don't want to see everything be Palantir up 105% in 8 months. I want to see, the good fundamentals come in, but also hesitancy, because that means it's not a bubble. That means everybody isn't getting in if they think it's doomed. No. So I like to just see, kind of normal growth in these companies and some hesitation and fear, or whatever you want to call it, doubts, and then have the stock be at a more inviting level, maybe even a value in some cases. We did see some value on Liberation Day sell-off. So I really encourage people to buy these AI infrastructure stocks on that big Liberation Day sell-off. But if you miss that, maybe another chance is coming up soon on this weakness. So I took a look at a bunch of the infrastructure stocks. So what does that mean? It means Supermicro and Vertiv, which supply the racks. They're in partnership with NVIDIA. They're in the data centers. They're like services as well for the data centers. And both had good earnings reports, Vertiv especially. I own Vertiv in my own personal portfolio and in Zach's value investor portfolio. But Vertiv still, this year, earnings growth of 34%, next year, 27%, this year on sales growth of 24.5%, and the next year, 15.8%. So they have been beating and raising. This is all good. Stock has did surge off Liberation Day lows. It was getting a little stretched again. So not surprising, it is pulled back. It's down 6.8% in the last 5 days. This is the type of pullback. Other than Palantir, everything else is under 10% pullbacks right now. So these are just kind of a normal, it's not even a correction. Correction would be 10. It's just a normal pullback, but I have it on my watch list. So it's getting a little more attractive here is what I'm saying. So forward PE is now at 33.8 and has a PEG of 1.1. So those are coming down a bit. The PE was getting up there. It had been at 40 before the Liberation Day, but now earnings have also grown. So it's pulled back a little bit. If I could get it at 30 or under, I consider that to be very attractive for Vertiv. VRT is the ticker with Vertiv. And then Supermicro, also again in partnership with NVIDIA. SMCI is that one. It's been much more volatile. Supermicro is down 6% in the last 5 days. It is up 41% year to date, and that is outpacing Vertiv, up only 6.9 year to date. But this one is cheaper, forward PE of 17 now with a PEG ratio of 0.89. So the 0.89, that's value and growth. Earnings expected to be up 23% this year and 29% next year on 48% sales growth for this year. That's pretty strong, and then 15 for next year. But Supermicro has had some growing pains. And when you get an influx of business like this, it is hard for these smaller companies to execute. So keep that in mind. But market cap of 25.8 billion now. So it's a little bit bigger than I remember it before the AI revolution. So that's Supermicro, SMCI. So those are the ones in partnership with NVIDIA. So where they go, NVIDIA goes, and vice versa, basically. But then also on the data center side, we have people who need to be building the data centers, powering the data centers, and then cooling the data centers. I've covered some of these stocks in various podcasts. One that I like a lot is Sterling Infrastructure. I own it. I also own it in the Value Investor, ticker STRL. And they are in, I think, technically classified as like engineering. Let me look to make sure. In the industry, yeah, engineering R&D services, because they do build the data centers. Plus, they build a lot of like just big buildings, and they build the e-commerce warehouses. So Amazon distribution centers, they are involved in building those, but that kind of went on the back burner when the data center side surged. But they did say on the recent conference call that 2 years ago, they had a meeting with Amazon's leadership about where the warehouses were going. And they said in about 2 years, they were going to start building new warehouses once again, because things change. You have to upgrade facilities or build completely new ones. Maybe you want bigger, maybe you want smaller, whatever is going on. And then in the fourth quarter of last year, 2024, Amazon actually said, hey, we're starting this up a little earlier. So they're now building some of these warehouses and e-commerce distribution facilities again for Amazon, mainly in the Northeast, they said. And they thought they'd do 1 to 2 this year because it's just kind of starting up again. But now they're seeing 7 to 8. So this is another driver. It's not just the data centers for a company like Sterling. They're on the smaller side. They're a mid cap now. 8.4 billion is their market cap. Shares did surge to new all-time highs on this recent earnings because it was that good. Earnings expected to be up 45.9% now, but just on 0.2% sales growth. They have a pretty big backlog. They are buying an engineering firm that specializes in power and electricity side, which is big with the data centers. And so they feel like that's going to be very good synergies with the rest of their business, especially with the semiconductor type of customer at the data centers. So with the NVIDIAs and the Amazons and Metas and those, that they're going to be able to be like one-stop shopping then. So we'll wait. That deal hasn't closed yet. We'll wait and see what happens with earnings and sales and all of that when that closes and they see the benefits of that. But they're spending about $500 million to get that company. So we'll see. But forward PE now is at 31. PEG is at 2.07. So a little more stretched because it has had the big surge. Year to date, the shares are up 63%. So they did sell off big on Liberation Day, but a big bounce back, but down 6.4 in the last 5 days. So I'm watching this one closely. Might be interested again if the PE can get 30 or under. And we get a little bit more of a pullback here because this build out in data centers and even other big types of buildings is real. And they even talked about, companies, their customers are building even bigger now, because if they're going to have to figure out a way to power the facility, might as well go big and then figure out the power. So if you're going to build like a whole power structure embedded in the facility itself, then you're going to build even larger. So that is also impacting, and that would impact on the power side. And the stock to watch for that is GE Vernova, which is G as in George, E as in Edward, V as in Victor, GEV. Many of you know this one. It is one of the red hot AI stocks. It only went public in 2024. And so it was at new highs after its earnings report, but coming down a bit off of it, down 5% in the last 5 days, still up 77% year to date. Its chart this year looks very similar to Sterling's, but they are making like the turbines that go to power these data centers. And so big demand for that. And the fundamentals are there. Earnings growth, 44% this year, expecting 64% next year. That's pretty insane earnings growth for a company that is 164 billion market cap. 164. This is not a small company to see this kind of earnings growth. Sales on this year, 6.7, next year, 11.4. So seeing a little bit more demand for 2026. It is not cheap, and it hasn't been in a while. That's why I'm really watching it for even a bigger pullback here. I feel like it's gotten a little ahead of itself. Forward PE of 75. PEG ratio even, it doesn't help. We got that earnings growth because the PEG is at 4.2. So just a little expensive for me on the energy side, but keep it on your watch list. If we get an actual like bear correction, like we just saw with Palantir, where it's down over 20%, then it's starting to get a little more interesting, but still pretty stretched on these ratio side of things. So, but I'm keeping it on my watch list because I do like the energy area so much. Okay, but there's another area for the data centers, and that's the cooling side. And you have companies like Eaton. ETN is the ticker there. E is in Edward, T is in Tom, N is in Nancy. And Eaton has a lot of different divisions, so it kind of gets lost in the discussion about AI and the cooling side, but this has been driving the stock the last couple of years. Shares were at new all-time highs. I'm assuming this is its 5-year for sure, but I'm assuming 5 or all-time highs. And now it too is pulled back because just a little too hot here. So they have a market cap of 135 billion. Again, these are not small companies. Eaton's been around a long time, but forward PE now is at 28.9. PEG is at 2.57. So a little pricier here. This is what I mean about NVIDIA not even being that expensive, at least not on a PEG ratio perspective. It's like cheap, but I digress. Eaton earnings up 11.7% this year, 13.8% next year. These are nice double-digit earnings growth, but I've got to get the stock cheaper if I'm only going to get, in the low double digits. I want to get that PE has to come back down closer to, 20 maybe even versus 30. So sales 10.6% this year, 9% next year. That's very good sales growth, nice double digits for a company of this size. Earnings growth, everything looks good, solid, is executing, but shares down 3.4 over the last 5 days. That is not, dooming by any means, but year to date, it's up only 3.7. It did have a big decline on Liberation Day. That was a real buying opportunity. And then it has surged up to new highs, but it's kind of just back to where it started the year, which was near its new highs. So this stock kind of stalling out. And I feel on the valuation side, even though, its actual business is performing very well. It's just, what are you willing to pay for those earnings and for those sales? And on a price to sales basis, let's take a look at that because we haven't mentioned that for many of these. So price to sales is pretty stretched on Eaton at 5.2. That's obviously not what we've seen with Palantir or even NVIDIA, but for a company like this, 5.2 is definitely not on the cheap end. So that's Eaton, ETN. Keep it on your watch list. And then I want to mention one other that is also involved in the cooling. I do own it in my own portfolio and in Zach's value investor, Modine Manufacturing out of Wisconsin. They are really expanding on their cooling for these big facilities like data centers. So that's really driving their business. They had another beat last quarter. Earnings expected to be up 14.3 this year and 30.9 next year on low double-digit sales growth, 11.3 this year, 14.1 next year. They have a 7.2 billion market cap now. They were much smaller before the revolution, but they too have been growing. They've been buying and acquiring other companies where they need certain expertise. They also are global. They have a manufacturing facility in India, and they do supply global customers. So they have been able to avoid some tariff implications by having some facilities outside of the U.S. to service some other customers. But yeah, like that is a lot that's going on with Modine right now. And most people have never heard of Modine, and rightly so. They used to focus mostly on the cooling in the auto industry, but they are in a turnaround kind of situation. And it turns out the timing has been good for them to move into these other areas that are hot right now, basically. So thermal solutions is what they are doing. They are investing $100 million to expand capacity to meet the demand for the data centers. So some of these companies starting to do more CapEx to execute, really, because that's what it's all about. It's not necessarily just that you're getting the business in, but you actually, you have to execute on that business. And that is the harder part. Now, I'm trying to find out, I'm pretty sure I just mentioned all that stuff about India, and I'm like thinking, was I getting it confused with some of my, no, I'm not. Because I have been following a lot of these AI companies, and I was like, was it Modine that is in India and is avoiding some of the tariffs? And I'm pretty sure it is, because they do have operations in North America, South America, Europe, and Asia. So it was them. I didn't want to tell you something that wasn't going on. But again, the cooling is a big deal. These chips take up a lot of energy and they get very hot. The last thing you want is fires at a data center and destruction of a data center. So cooling is vital. It takes water, it takes power. And then you have to have a special type of cooling system. They have to work with a lot of their customers to get that in place. It's not just hooking up the HVAC. So you need more than that. And Modine is one of those. So that's one to keep on your list as well. Shares down 3.7% in the last 5 days, and year to date up 16 year to date. And it's been not as widely followed. So it too had the Liberation Day sell-off. It was pretty extreme. It's bounced back and it's near its highs again, but still a little stretched here on valuations at 29 on the PE. PEG ratio is at 0.87 though. We do have that low PEG with Modine. So I'm liking that. If I could get it like at 25 times, or, if I just anything cheaper than 30, I'm liking Modine at those levels. Still one of the more attractive of the AI infrastructure plays. Price to sales ratio, just 2.7. That's not a value yet, but for all of these that are trading near their highs, that's pretty low. So I'm liking the valuation picture overall, even though the shares have, rallied again. But look for these sell-offs. Look to get in at these cheaper levels. So that is just a smattering of some of the stocks in all of this infrastructure area. Many that I own, some I don't, but I like them all here. Yes, even Palantir. That's not in infrastructure. That's in the actual product side. But that's just way too expensive for me here. And there's other ways to play AI because the money is being spent. The Mag 7s are building these data centers. They need to get those up and running before they can ever have a product. So look for the infrastructure side. That is where the building blocks are, and there's real money going in there. These are real contracts these companies are signing and executing on. So I love this area. On any bigger pullback, I definitely am interested. But I'm kind of encouraged by this mini pullback that we're seeing right now. If we could get a correction, which is 10%, or a bear on some of these, like Liberation Day was a bear, then very attractive, and you should be buying in or adding to your positions. So let me recap the stock tickers we talked about. There was, of course, Palantir, PLTR. Is it absurd? I don't know, but it's pretty crazy. So I'm staying clear of that one. NVIDIA, interesting here. We're waiting for the earnings, but very attractive on a PEG ratio basis for sure. NVDA is NVIDIA. Then we have the racks and services at the data centers. Vertiv, V as in Victor, R as in Robert, T as in Tom. Supermicro, S as in Sam, M as in Mary, C as in Charles, I, SMCI. Then we had engineering firms building the data centers. Sterling Infrastructure, S as in Sam, T as in Tom, R as in Robert, L as in Larry. Then you got to power it, GE Vernova, G as in George, E as in Edward, V as in Victor. Then you got a Coulomb, Eaton, E as in Edward, T as in Tom, and N as in Nancy, and Modine Manufacturing, M as in Mary, O. We'll just say O. D as in David, MOD, Mod. And I own, just to repeat, Vertiv, Sterling, and Modine out of this list. And I'm keeping them all on my watch list. And if I can get them on sale, I will. And you should too. So watch these. And I'm sure I'll be covering them again on another episode, especially if we get even a bigger pullback. But you want to be sure to subscribe. Don't miss a single episode of The Value Investor. There's a lot going on. There are value stocks out there. And there's some stocks that might not be dirt cheap on the PE or price to sales basis, but are still maybe buying opportunities here. And so we aim to cover it all. Be sure to get us on Apple, Spotify, Amazon Music, SoundCloud, just about anywhere you can get podcasts. We are there. Also on YouTube. I know many of you subscribe just to hear our audio podcast there. And you will get a bunch of them in addition to The Value Investor, including ETF Spotlight. And our earnings podcasts are also over there. But be sure to get us somewhere. And I will see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.